Welcome to my channel. Today we will be talking about the best funding options for scaling an Amazon FBA business. I've been in the FBA game long enough to know that scaling is where most of us hit a wall. You're profitable, but you need big inventory buys, major marketing pushes, or new product development, and your cash flow just can't keep up with that pace of growth. I've personally used a couple of these options, so I can share what really works. When you're ready to scale, you need to look beyond personal savings and credit cards. They're great for starting out, but they cap your growth potential. 1. E-commerce specific lenders and advances. This is usually my first recommendation for established sellers. Companies like Payability, Sellers Funding, or even Amazon's own lending partners are built specifically for our business model. The pro. They look at your Amazon sales history and store metrics, not just your personal credit score. The approval is fast. I've had funding offers in a couple of days. They understand the cash flow cycle of an FBA business. The con. The cost can be higher than traditional bank loans, and repayment term can be short. You need to be absolutely sure of your profit margins and sales forecasts to make this work. 2. Lines of credit, traditional or fintech. A business line of credit is like a flexible safety net, and it's what I recommend once your business is more mature. The pro. You only pay interest on the money you actually use, and you can draw from it repeatedly. This is perfect for those unpredictable inventory spikes, like preparing for Prime Day or the holiday season. It gives you incredible flexibility. The con. Traditional banks require a solid business history, a strong credit score, and usually collateral. Fintech lenders are easier, but again, the interest rates might be higher. 3. Revenue-based financing, RBF. RBF is a powerful option for businesses with consistent sales. How it works. The lender gives you a lump sum, and you repay it as a fixed percentage of your daily or weekly sales. If sales are slow, you pay less that week. If sales are booming, you pay more. The pro. It aligns the repayment with your cash flow. There are often no fixed interest rates, but a fixed capital fee, so the debt doesn't compound. It's truly flexible. The con. It can feel expensive if you do the math on the annual percentage rate, APR, and it takes a small chunk out of every single sale, which can be a psychological hurdle. My personal experience taught me that the best option always depends on why you need the money. If you need a small, fast cash infusion to restock before a major event, an e-commerce advance is brilliant. If you're building a new warehouse or buying machinery, a long-term traditional term loan is better. Always choose the option that fits your cash flow and your growth timeline. With that being said, thank you for watching. For more finance videos, kindly check my page. Please like, share, comment, and subscribe to my channel. Thank you.